Hello, hello. Welcome to the Five Talents Podcast. I'm your host, Abel Pacheco. I interview the top commercial real estate investors and industry experts so you can learn from their experiences. So if you're an investor, a high W-2 earner, or real estate or tech sales professional that wants to invest in real estate without having to manage properties or leave your day job, then this podcast is for you. Or if you're already investing in real estate, but you're doing it part-time and you want to become a full-time multifamily or full-time commercial real estate investor, this podcast is for you too. You're going to learn a ton. You will learn from real-life multifamily investors and other professionals in the industry. They're going to share their blueprints for success, and I'm super excited that you're here. So I hope you enjoy the show. Hello, hello. This is Abel Pacheco, your host for the Five Talents Podcast. We're just super excited today to have a very special guest, Mrs. Sandhya Seshadri. Sandhya, how's it going?
Going great. Thank you so much for having me on your podcast. I'm very excited to be here.
I sincerely appreciate it. I've seen, your face more than a few times. I think we've ran into each other maybe at a conference or two. You've got a memorable face, and I maybe even, had some short conversations. But I really dug in and got to know you a little bit better during the Raising Money Summit with Adam Adams, and I was like, wow, she is amazing. What an amazing guest! I would love to have you on the show. And we're humbled and appreciative that we have somebody like you with your experience that would join us. So thank you very much.
Great to be here.
Thank you. So let me first, for our guests that may not know, a little bit more about you, I want to give them some insight, and then I'll turn it over to you really for an introduction. But the reason I wanted, Sandhya here was because she's got an amazing professional background and an amazing really multifamily, both active and passive experience. So to keep our listeners out of the suspense, she's invested in about 3,500 total apartment doors. So multifamily doors. She's passive in about 3,000 of those doors and active in just under 500, 480 or so. And that's like $250 million worth of commercial real estate. So to say that she has a little bit of experience is kind of an understatement. She's both an apartment syndicator and an asset manager. She has her bachelor's and master's degree in electrical engineering. And she had a really extensive background in the tech industry for Texas Instruments. She had over 14 years there in various technical marketing management roles. She led teams that had revenue in excess of $80 million and managed budgets of about $28 million. So, a lot of background, a lot of experience. Acquired her MBA 20 years ago during the time at SMU as well. And, just really on that quest now to really crush it in apartment syndications. And she's just a really, solid, active general partner and sponsor of these deals. So I thought she would be a perfect guest. So thank you very much, Sandhya. Why don't you, in your own words, tell us more about yourself and what you're doing today? That'd be an awesome place to start.
Yeah, I've lived in the Dallas area for over 30 years. So this is my target market with multifamily. And so I've also extensively invested in the stock market because of my MBA education. And so I've naturally loved numbers. That's what led me to this engineering career. So now that I'm in multifamily, I love to underwrite deals, analyze deals. That's one of my favorite things to do. And I try to invest mostly in the Dallas market because I'm so familiar with it. In terms of my experience in real estate prior to that, I stayed away from single family only because I just didn't like the idea of tenants, toilets, and trash. And I didn't want to get a call in the middle of my Thanksgiving dinner that somebody had a leaky toilet, etc. I always thought I had to self-manage. So when I heard about multifamily and the benefits and economies of scale, and that you can employ a third-party property management company to run the property for you, that's what got me interested. Because I've always wondered, every rich person I know is invested in real estate. So how do I get into this, but without getting my hands on and having to do day-to-day operations? So that's why multifamily for me was the perfect fit. And I joined a mentoring group, got my education there. And, I see mentoring groups as sort of like country clubs. So when you get this exclusive membership to this country club, you have access to these amazing like-minded folks with whom you network, you learn the business, and you find your potential partners there. So I invested passively in a lot of deals because I had money from my previous career at TI in retirement funds that I was able to roll out and put it into an EQRP. And I could use that money to invest passively in other people's deals. That's why I'm invested in so many deals. And with each deal, you learn something new. And the thing to remember is that you cannot use your retirement funds to syndicate your own deal. So that was a perfect place to learn and invest with others and establish connections. So that's what led me to multifamily, passive investing, and now to the active side.
Yeah, that's so awesome. Just to hear the way it all unfolded, and even in this first part, to kind of to hear the success that you had so rapidly, because you haven't been commercial multifamily investing for 20 years. When was your very first passive investment?
Was 2 years ago, actually.
Okay. So 2018, in 2 years, what were your goals? Do you remember it saying before you did 2018, I'm going to invest in X amount? What was the number? And did you ever think you were going to be at 3,500 like in 2 years?
I didn't think I would invest in so many deals, but my goal was to learn the business enough to feel confident and comfortable to find the right partners. And within the first 12 months to be able to syndicate a deal. That was my goal. And I felt like once I got all the training and education and learned to underwrite, and I had coaches to help me with it, the passive investing was the first step because it's still that intermediate step. I call it the internship phase, where you've got some knowledge, but then you're not quite ready to run the property yourself. So when I invest passively in someone else's deal, I got to see how they run it. I got to see what I liked about it, what strategies actually worked. You know how they come to you and present a webinar and say, we're going to do this and this and this. Well, I got to see how all that actually happened. And then I was ready. Once I did a few passive deals, I was like, okay, this doesn't seem so unreasonable. This is actually happening to normal, real, simple people like me, your average person, not somebody who has tens of millions of dollars in their hands kind of thing, right?
Yeah.
So that was very real to me because I always thought, okay, apartments cost millions and millions of dollars. Ordinary people with normal W-2 jobs can't afford them. And then I learned about the syndication. So my first goal was, again, to try to syndicate at least one deal within my first 12 months.
Yeah. And the apartment complexes do cost millions of dollars. The difference is you don't have to have the millions and millions of dollars on your own, right? We end up syndicating these things and putting them all together. And so you quickly learned, oh, this is awesome. I get my quote unquote internship. And that internship was your passive investments. You learned, kind of what you liked and didn't like. And now as an active partner, as a general partner, a syndicator, somebody putting these deals together, now you're on the other side of it, delivering, the end product to your investors that you want to deliver. So tell us about what you learned, maybe what you liked and didn't like, and kind of what you're applying today as an active partner.
So I took bits and pieces of what I learned from each of my different passive deals. And now I'm doing all of those things in my active deals. Something as simple as reporting, right? You get monthly reports when you have passive deals. And I realized very quickly exactly the type of information I wanted to receive as the customer, so that when I have my deals, this is the kind of information I want to include. Now, there are some investors who just care about their returns and they don't want to hear all the details of how you're running the property. And then there are others who are sort of what I call the active passives who want to hear the whole story. So what I've done is we put a small summary together that gives you like an executive summary of exactly a snapshot of what's happening with the property. But then we provide links and details if someone wants to go into the financials or ask questions. And that way it's still a brief one-page report that you get, but you can click on various links to go in depth on as much as you want. Like, let's say we had a problem, we had a delay, we had to get rid of our maintenance guy and get a new one, etc. I mean, how many people want to know all those details, right? But some are curious. So they can always click on the links for the bigger stories, but otherwise they get a summary. So I really like that, for example, is one of the things I learned from investing in deals. Another thing was I always try to invest in deals that are in my target market. So my target market being Dallas, I try to invest in other deals in Dallas because then I could drive and actually see what was going on there. And I took those lessons learned and said, oh, this strategy actually works in this kind of a property. So I could take those and implement it in my property now that I have some. So things of that nature, you really learn practical side of things when you invest passively that you can then use to syndicate, or you can just use it to learn the business in your market to be a more well-informed passive investor, depending on what your goal is.
Yeah, I agreed. I've always had a lot of, in the professional world, tech world, our backgrounds seem a little bit similar. I had a business that wasn't quite as big as yours, but about a $57 million a year kind of business. And we managed the reports and did the weekly reporting and monthly. And so I gave my information up to my VP, and he summarized it to his, the CEO of a $1 billion company. So, we're trying to summarize that executive summary, just enough information that they can, digest and to relate it back if they were passive investors that don't care about any of the details. But for an active passive, somebody probably like me, I invested in the first, I invested first like you passively. And I wanted to know how it was working and what happened, because my goal was to become active as well. So you're kind of catering to both of those worlds, right? Did you always know that you were going to be an active partner from the very beginning? Okay.
I knew that right away. So I joined at the highest level into this mentoring program so that I would have coaches to help me right away. Because this is one of the few programs where when you join and you get all the training, you also get unlimited access to a variety of different coaches. So I was constantly underwriting deals. And I remember the first time I tried to underwrite a deal, I think I had to go back and forth with the same coach like 2 or 3 times for that one deal to underwrite it. And it was just a practice underwriting. I wasn't even thinking of actually making an offer. This was more of, okay, let me practice, right? Yeah. So I had to really get comfortable with assumptions you can make. And those vary depending on the type of deal, etc. So underwriting is one of the most important things that I think you have to fundamentally understand. You may not enjoy doing it, but knowing the assumptions and whether those are reasonable or not for a deal is so crucial, because your numbers can change. Like one little number, like as an example, the reversion cap rate can completely change the returns on a deal. So one of the deals we syndicated last year, we assumed a reversion cap rate of 7.4%.
Wow. Very, very conservative for those that aren't listening.
Extremely conservative, right?
I don't even know what you bought it at, and I'm already saying, conservative. Go ahead.
So there was over a 2-point difference in the cap rate when we underwrote that deal in terms of the purchase cap rate versus reversion cap rate. So what is cap rate? Cap rate is basically the net operating income of your property divided by the purchase price of your property. And that's the in-place cap rate at which you are buying properties. So today in the Dallas area, this is October 2020, properties are trading at a 5 cap rate today. A year ago, they were also in that range of maybe closer to 5.5, maybe closer to 6 sometimes, depending on the deal. Exit cap rate or reversion cap rate is a prediction of, in a few years from now, when I'm going to try to sell this property, what is the market going to bear for a selling price to determine my selling price? So if the exit cap rate is higher, let's say a 7 cap, that is a more conservative underwriting. So I'm basing my sale price on a higher exit cap, which means that my underwriting is more conservative. So if I had just put in a 6 cap rate instead of a 7.4 cap rate, my returns would be way higher for the investors. But I like to underpromise and overdeliver. So in the deal we underwrote 14 months ago, and actually we underwrote it 18 months ago and then acquired it 14 months ago, it was a 7.4 reversion cap. I'm sure we're not going to sell it if the cap rate is 7.4 in a couple of years. We're going to wait and sell it when the cap rate is more like a 6 or even less, or 6.5. Which means that I'm going to please all my passive investors by giving them a much better return than I had originally promised. And that's the way you want to go. So that is just an example of one little number that goes into an underwriting spreadsheet. So to really understand your spreadsheet so that when someone presents a webinar and says, I'm going to double your money in 4 years, 5 years, right? Okay, well, of course, if you assume the same cap rate as your in-place cap rate and your reversion cap rate to be the same, yes, my deal also will double. But I'm not going to assume that. I'm going to assume it more conservatively. So you don't even know that as a passive investor until you understand all the terminology and how a deal is underwritten.
Yeah.
So passive education is so important before you become an active investor, is to really understand all of this terminology, to properly evaluate a deal and see how conservative the assumptions are, especially given the climate we are in right now.
Yeah. Wow, that was awesome. So thank you so much. There's a lot of detail in here, right? And so for the passive investors that are maybe hearing this for the first time and you have no idea what a lot of these terms are, one of the reasons that we say education is so important is just to really, if you're going to invest in some money, some money into a deal, you really want to study and understand what you're getting into. And so there was a number of terms, right? She mentioned going in cap, the reversion cap rate, NOI, purchase price, your predictive assumption on what we're going to sell it at, and then all of the different the assumptions that you're making. And we'll kind of slow this down. I'm going to go back and ask you a few more questions. I think it'll help everyone understand. But you want to take notes on a lot of these bullets. These bullets that we mentioned, the terminology, they can be found. You can Google them, you can wiki them, you can, look, ebooks that are on multifamily. We've written one that cover a lot of this terminology as well. And so you're really trying to understand it. So that way, when you're looking at a pro forma, an offering memorandum, which includes a pro forma, but you can ask really good, highly intelligent questions and then start to understand what they mean and weigh one deal versus another one versus a market versus another deal versus in another market. And so you're really kind of, really want to peel back the onion a little bit. And so let's dive into each one of these, right? So a couple things you mentioned, right? You mentioned the going in cap rate. The cap rate, Sandhya, is in your market. This is Dallas. You said last year versus this year. What were those numbers? Last year was a 5.5, and now it's a 5-ish. Something along those lines?
Yeah, cap rates have really compressed in the past year. I'm seeing every new deal that I'm underwriting right now is being offered at a 5 cap or even slightly less.
Yeah.
And so that means that, you're paying more for a property for about the same net operating income last year versus this year. You're actually paying a little bit more because they're saying, well, we withstood COVID and there's no drop in our collections. So why should we demand any less for our property? So sellers are not really going down on their prices just yet.
Yep.
I'm not seeing any forbearance deals or things like that to find a bargain, if you will.
Absolutely. So for the passive investors, the way we value and price a multifamily deal is not based on your next door neighbor's age or vintage of property, which it has a factor, but what it's really valued on is how much income the asset generates. And so a cap rate is basically, it's a return percentage. If you were a cash buyer and could buy a $10 million building, how much income or my cap rate will I get for my deal in return? To make it simple, if I was buying a $10 million deal and it was a 10 cap, which is probably unlikely that we're going to see, but if that was the case, I would be getting, basically 10% return on my dollar every single year. That would be $1 million a year in this example. And it would take me 10 years to pay that property off if that was the only thing to consider, no debt terms or anything like that, right? And so what we're doing is we're buying income streams and not apartment complexes. So one income stream or one apartment complex may kick off 5% return and another one may give 6%. And so that's what, Sandhya is talking about is we're in the underwriting, you're analyzing where your investment's going to be best had and a return on it. So this is really cool, Sandhya. And then you mentioned something else. Go ahead.
On that.
Yeah, go ahead, please.
That's the biggest difference between how single family versus multifamily are evaluated so differently, because two single family homes next to each other, the price per square foot is going to be about the same because it's based on the location, the neighborhood where you're at. Versus two multifamily deals, two apartments right next to each other. If one is operated more efficiently, which means their revenues are higher, their expenses are lower, so that their net operating income, which is the difference between revenue and operating expenses, that net operating income is higher for one apartment versus the other, then that apartment is going to be valued more than the other apartment next door. So that's what we call forced appreciation. So a really good operator is going to take over a property and make it run more efficiently by doing things to increase its revenue and lower its expenses and therefore increasing the net operating income of that property after they take over, which is why the property is going to be worth more than when they bought it for. So that's what a good operator does. And that's the kind of person with whom you want to invest as a passive investor so that you make money on the deal.
Absolutely.
Yeah.
That's pretty much always the plan, right? Is like, hey, how do we force the appreciation up? So I'm bulleting that one too, because that one's a good to cover. So the way you broke it down, for somebody that's okay, you're still trying to follow, right? And you have your pen and piece of paper out. The top of the line of the underwriting is the income, and then you subtract your expenses, and that brings your NOI, because we haven't talked about debt service coverage or none of that stuff. We're not talking about debt yet. We're just talking about income, expenses. And you had a formula, Sandhya. You said, here's how you get your cap rate. It was NOI divided by the purchase price, right? So if you have those two things, you can figure out the cap rate. Or if somebody is telling you, hey, this deal is trading at 5% cap rate, and you don't know the actual purchase price, if you had the NOI, you can figure out the purchase price. Any two of these numbers out of the three, you can figure out the other, your NOI, your purchase price, and the cap rate. And so the reversion cap rate, or some people say, hey, I'm going in at 5, is another kind of, just a word. And then you say, oh, what's my exit, or my exit cap rate, or reversion cap rate? All those are the same. The bigger the spread, like Sandhya mentioned, the bigger the spread from where you bought it to where you're exiting, that means you're being more conservative. Because she also mentioned something. You mentioned that cap rates, even though people thought at the beginning of this year that there was going to be fire sales on these apartments complexes, they're really not. It's actually the opposite of what we kind of expected, which people are demanding or asking for more money for these deals. So the cap rates are compressing, they're getting smaller. And that means the deals are at least the asking price is even higher than when we were paying for last year. So anything else to add there, Sandhya? Because that was really good explanation, all this stuff.
So the purpose of that was I just picked one parameter, which is the reversion cap rate, to explain how you are supposed to be careful when you do deals. And the thing to remember is that there are so many other things that a sponsor can sort of change or manipulate in a good way in the spreadsheet to make the numbers or your returns as a passive investor look very different. So almost every number or line item in those analyzer spreadsheets, you want to make sure it's thoroughly understood and validated by the sponsor. They're not just pulling numbers out of thin air, they're actually validating it. So if they say that I can run this apartment complex at an annual budget of $800,000, well, who said that? Did you have a property management company local to that area actually agree to those numbers? Did they give you that budget? Did they agree to those rent increase numbers? Did they agree that your R&M and maintenance and payroll and all of those expenses that go into a budget, did they agree on those numbers? Did your insurance quote align with those numbers, right? So these are all the questions to ask is, can you give me examples or can you give me proof that all of these numbers have been validated by actual vendors rather than just being copied from the broker's OM or operating memorandum? Because the broker's OM tends to be a little more optimistic. So you always want to make sure your operator or deal sponsor with whom you plan to invest has validated all of those numbers so that the numbers are actual projections of how this property will be run in 60 or 90 days when they take over the property. So every number there, like property taxes, is a huge number to always be very, very, very aware of. Because in Texas, there are certain counties that go after you in those property taxes, and you should plan for 85 to 100% of the purchase price times the tax rate for your actual property tax expense, at least by year 3 at the latest.
And you were in Texas, right? So somebody else that's listening in some other area may use different tax implications, millage versus whatever. But the point is you're trying to be conservative through every one of those bullets,
Mhm.
every single one of them.
Yeah.
And yeah, absolutely right. And the way you're running these, like Sandhya mentioned, the more conservative you can be up front, the better opportunity you have if you are an active investor. And let's say, I think we do have a lot of listeners, Sandhya, too, that maybe general partners for the
Mhm.
first time, somebody for the second and third time as well, and they're trying to get another deal in writing. One of the things you mentioned too was like it's so much better to underpromise and over deliver.
Mhm.
And this is a lesson, even
Mhm.
for me in my technology career,
Yeah.
with my family and friends, with anybody that I really work with as an investor. The better you are at under promising, and the easier it is for you to over deliver. And I heard this, I can't remember who said it, but someone said, hey, if you're promising a 15% return and you deliver 15.2, you're an amazing guy. You are the
Mhm.
individual or guy or gal that delivered on exactly what you said, and that you're awesome. But if you promised a 15.5 and delivered a 15.2, you missed. And now
Mhm.
I'm upset.
Yep.
So
That's
it's
exactly.
way better to promise 15% or even lower, or whatever, whatever. No, I'm just taking that number out of context, but whatever percentage you're saying to your investors, much better to be conservative and under promise over deliver. It's easier for you to hit your targets and do well. Anyways, those all good
Yeah.
stuff.
One thing on that is you don't want to sandbag it too much to where you promise one thing and you deliver way more than that either. Because in some case, when you have some very high net worth individuals, you're sort of surprising them with the return and they're not quite prepared from a tax standpoint for that either. So you want to be not too off from your numbers either way, but you want to be always like the example you just quoted to be slightly better. So
Mm,
if you promise 15%, you don't want to be at 25%. That's too
yeah.
huge a number. They're going to say you just sandbag the whole
I,
deal just to make yourself look good. So you don't
I
want to
hope
do
to
that.
have your problem in the future.
Yeah,
I hope to at least have that problem a few
I know.
times, which is a couple of investors be upset at me for giving them too much of
Yeah.
return. I'll be like,
Okay.
okay. Yeah. But anyways, this is awesome. This is an awesome one. Hello, hello. You're listening to the Five Talents Podcast. I'm your host, Abel Pacheco. If you're enjoying this podcast, then I know you're serious about achieving financial freedom. Are you ready to create your own path through multifamily investing for yourself and your family? Then I know you're going to appreciate our Investor's Guide to Multifamily Investing. It's titled Tackling Commercial Real Estate the Easy Way. We use this guide to invest ourselves in $93 million worth of real estate. So we're going to show you the basic mechanics of multifamily syndications and how to evaluate your next passive investment opportunity. So the best part, if you subscribe to our podcast now, leave us a review and a rating. I'm going to give you a free copy of our ebook. So please take a moment to do that now. Once you've done that, go to 5tcre.com/ebook, 5tcre.com/ebook. Make sure to let us know you left a review and we're going to send you a free copy. So thank you so much for subscribing to the Five Talents Podcast. We really appreciate it. So let's talk about, the investors. I think we've touched on some of the technical underwriting, which is pretty cool, to kind of learn. And I think the passive investors are probably getting more education than they expected, at least from this interview. You know what? We'll leave one more thing. From your perspective, if someone is not a financially, that they don't have that financial background, they've never really dug into P&Ls, they've never really looked at these numbers, and they're looking at the spreadsheet like, well, what's going on? What's the easiest, maybe a nugget or two that you can give to somebody that says, if you know nothing about these financials, this is a great place to start. Here's an exercise. Go do this one. And it'll at least get you towards, closer towards the world.
A simple question that you always want to ask your sponsor is, has someone else validated all these numbers? Did you really get a term sheet? Did your lender agree to these numbers? Did you really get your property management company to agree to these numbers? How did you figure out that these rent bumps are going to happen? Did your PM property management company agree to this? Have you done a good comparative analysis, what we call comps? of the properties around within a 1 mile radius, are there fair comps, right? If one property has these, sparkling pools, etc., like in your background, and a gorgeous looking property, yeah, somebody might pay $200 more to live there on a same size of bedroom because that property has more amenities, versus your property, the big property, might not be as nice. So are they truly comps? How do you know that you're going to achieve the rent bump? Is a fair question to ask, without fully understanding any of the financials. These are still very easy questions to ask the sponsor. Show me how you justify every number on your analyzer spreadsheet. Don't just tell me about the market. Tell me actually that this property charges more. It is a fair comparison. The property management company has agreed to all of these numbers, etc. That would be one of the easiest things to do. But another easy one is the NOI over cap rate that we talked about. Did they pay too much of a price for this property? It would be easy to look up property records and say what they sold for within a few miles of that property. So you can just say, for comparison, properties are not really selling at this 5 cap. They're more selling at a 6 cap or whatever. So you're overpaying for this deal, right? That's something you can just look up by looking up property records without actually having to do financial analysis yourself.
That's a great point. You know what I mean? Like you can go to the, I'm in Bear County Assessor's Records, BCAD, and I can go look in, and then you can actually make a couple calls or two if you're in a market you don't know and they don't have their information readily accessible or online, which I've dealt with some counties that don't, and you can give them a call, and this is public information, so you can see and do that judgment call for yourself and see what they're purchasing at. That's really great. I like the asking the questions too, because anytime, when Sandhya is making an offer, well, I won't speak for her. I'll just let her say, yes, I agree or not. On our deals as an active partner, the moment I'm, looking at the price, doing the underwriting, and we're kind of close to that LOI, there's a few people that are looking over that offer. The property manager that I'm using I don't show them my numbers. I want to see their projections on the way they expect this property to run, and I want to know their pro forma. I want to see their numbers and their judgment call based on the properties, because they look at the comps and they go through CoStar and they get, they're going to be held to all these numbers. So I want to see what they're looking at independently of mine. I'm also going to, meet with the lender, and because I'm also now a commercial loan broker, and I work with Peak. So I kind of end up doing this on the back end. I see the debt sizing, and I see the normalizing of expenses, the normalizing of the income, the business plans going in. And I realize, though, the lenders want to see it in a different way. So did you talk to your lender? Do you already have a term sheet, and do they agree with these numbers? And then lastly, for somebody like myself, really what I do, I still like a third party. I hire an asset management company that's, underwritten billions of dollars of these assets. And I'm like, I want to see your plan. And I look for those three kind of areas before we're kind of really going into, a PSA. And so, that's kind of, I think I heard something similar, Sandhya, which is like, you want independent, if you're a passive investor, ask these questions. And if they say, yeah, we've done these things, you can feel better about it without even, really understanding everything. Did I?
Correct. So
Okay.
make sure other independent people have valued the property and come up with similar numbers, especially lending and property management, to coincide with what the deal sponsor is saying, so that the numbers are valid and realistic.
Yeah, this is awesome. So Sandhya, thank you very much for your time. Before I have more questions, so don't go anywhere yet. But while I remember, where can our listeners, if somebody wants to get, further into your world, you've said something that really resonated with them, and they want to, talk to you, get some education, invest with you, et cetera, what's the best place for them to reach out to?
My website, which is multifamily4u.com, where it is multifamily number 4 and YOU.com, where the 4 is a number 4 and the U is spelled out. That is my website. So you can come there. You can provide your email address and name. And what I can send you is a passive investors checklist to vet a sponsorship team. Because the most important thing when you invest passively in a deal is the sponsorship team. Can they operate this property efficiently to give you a good return? So these are some questions to ask them before you choose to invest in a deal. And I say, think about how much homework you do. before you buy an appliance or a car. Here you are considering investing like 50K kind of money on a deal. Be very careful and do your thorough due diligence. Don't feel rushed into jumping into a deal just to say, hey, I'm invested in a deal, because guess what? The money is probably gone for a few years. So anytime it is real estate, it is money that is long term. It's not a short term investment. So be prepared for that capital to be missing or gone for a few years. And definitely have 6 months of living expenses saved before you invest in real estate, and thoroughly vet the sponsorship team. Nothing is more important than thoroughly vetting that sponsorship team before investing in a deal.
Yeah, that's good stuff. Thank you very much, Sandhya. Yeah, so if anybody wants to reach out, I would encourage you to do so. That'd be really great for both of us. And mention that you heard her on our podcast, and I'll ask for her to let me know in the future. I'll be blessed by it. So this has been a really fun conversation, and the other questions that I wanted to talk about, right, is like, what are you up to next? So you have a ton of doors, you're invested heavily into commercial real estate. You're an active partner. What are you doing right now? Are you guys underwriting and putting out a few offers a week? Or maybe talk to us about the numbers right now. Like what's it look like for you, and how many properties are you put offers out and walking tours, all that good stuff.
I'm still doing a lot of that. It seemed like suddenly the floodgates opened and we have tons and tons of properties out in the market now. I think there is a rush for people to be under contract this month so they can close before the end of this year and get some depreciation in for this year. So I have been walking a lot of properties. I've been analyzing properties, making offers, etc. And one of the things we always do in terms of conservative underwriting now is, at a minimum, we say no rent bump year one and possibly some in year two. And I have my property management company also validate this, because guess what? People are struggling to collect full collections from their renters. So what are the odds you can bump the rent even more and actually collect on that? So we assume no rent bumps year one, possibly no rent bumps year two, other than maybe a minimal, $25 to $50 kind of basic rent bumps without doing any significant upgrades. So we also don't have a huge capital spending budget for the first year. We just want to be able to take over the property, mostly let it ride as is, and see what we can do with it. Because one of the requirements from all lenders is about 12 months of reserves requirement that you have deposit in escrow that you won't have access to. So that's 12 months of your mortgage payment, including principal and interest, that you won't have access to for 12 months. And so we are waiting for that. We're putting that as a deposit and having access to that money only at the end of year one. And then we might take that and use that for some of the CapEx budget. Yeah. So that's an example of conservatively underwriting deals. So yeah, I'm still looking at deals like crazy, and then making offers on the one that still makes sense with a conservative underwriting.
Yeah. Okay.
And sticking to my maximum price, if there's a $500,000 difference between my offer and somebody else's preemptive offer because they have a 1031 exchange or something else going on for which they have to close, then it's too bad. I'm not going to try to compete. I know what my max is, and I'm going to stick with that.
Yeah. It seems like all the deals that we're looking at right now, cap rates are definitely compressing. I've come across more than a few C-class properties that want like 4.5 cap. I go, well, yeah. Number one, this is not luxury, and number two, we're in Texas. We're not in California. It's I guess it's just the time. It's that time, huh?
Yeah, and because the interest rates are low, they feel like we can afford the slightly higher price for the same property, and I'm like, that doesn't mean I want to pay that much for that property. It's a C-class 60s property. I mean, come on, with an old boiler and chiller, there's only so much I can pay for it. It's going to be that much less attractive to a potential buyer in 5 or 7 years when I'm ready to sell it. So there's only so much you can pay for it.
It will be interesting. It'll be interesting to see, what we come out with. But yeah, I'm starting to see the deals kind of, number one, open up. I'm starting to see the deals, the emails that I get from being on other investors lists come out, and I see those, and I'm like, okay, well, things are kind of happening. We're closing on a couple ourselves and excited about it. And yeah, so all that good stuff. So is there anything else, before we go, is there anything else that I didn't ask about, I didn't touch on, anything that you are, wanted to highlight? I just didn't, bring some exposure about, and, please take as much time as you want, in this last area of our interview.
So speaking as both a passive and an active investor, I would say that whenever you look at a sponsorship team, make sure that you ask for their track record before you choose to partner with them as a limited or as a general partner. What experience do they have? How have their deals actually done? Are they willing to talk about their failures and their toughest moments, how they overcame those struggles? Because if all you see is a fairy tale picture and every deal has been doing great, I don't know how realistic that is. So definitely ask to speak to some investors who've done business with them, either passive investors or a prior co-GP, for a true review of how this person does. There is no rush. Don't feel rushed to jump into a deal, either limited or general partner, just because you see everyone else doing that around you. You go at your own pace, at your own path. You just blaze your own trail. You don't have to follow the path of everyone else to get to where you want to go, because your destiny is different. So don't feel rushed to get into a deal and make mistakes. I hope that someone can learn from my mistakes that I have made, which is someone may sound perfect and may be the greatest person on social media, but look behind the scene, look under the hood, talk to someone who's done business with this person before, see if they truly did the things they did, or the project things happened, but they weren't an active player to make that happen either, right? So definitely talk to someone, get to know them well before you invest with them passively or as a potential partner. Because any of these deals, it's like a marriage. You want to date and get to know them really well before you jump into a marriage, especially if you're going to co-sign a loan with them as a GP, etc. It's a big deal. So don't invest with someone you just met just because it's a 506c offering and they offer it to the whole world. That's a lot of money you're going to invest passively or actively. So be very careful who you do business with and take the time to get to know them and don't feel rushed.
Yeah, good stuff. And on the closing note, it was the 506c for a passive investor that's not quite aware. On 506c, you can actually advertise, send it out, have investors that you've never met before, and that's okay. That's an SEC kind of regulation there. A lot of operators operate like myself, and I think you too, Sandhya, 506b investments. So we have to have a pre-existing relationship. And so sometimes you see deals come out and they're like, man, these ton of doors and looks good and pro forma and want to throw in some money. And I've never met with them before. So, but really important. You want to know, like, and trust the person you're going to be invested with. You're going to be invested with them for a while, for a number of years, like a marriage, like Sandhya mentioned. And then, you want your goals and missions and dreams, desires, hopes, those things, like you want those to align. Somebody may be, more risky and somebody's more conservative, and vice versa. You want more risk and are okay with a higher return with more risk. And then vice versa, you may not, you want more conservative. And so you want to invest with people you align with, or at least have the ability to diversify and know, between one investor, one market, between another deal and another, and kind of the assumptions that Sandhya had mentioned are valuable to go through. So all great stuff. Thank you so much. It's been really a pleasure having you on the show. This has been a fun conversation.
Oh, thank you for having me. And one last thing, make sure they have someone local to the deal, boots on the ground. If people are all doing remote control from other states and the property is located elsewhere, to me, that's a red flag. I need someone local to the property who can run at a short notice to check on it. So.
There you go. A lot of value to the very end. Thank you very much, Sandhya. Again, my name is Abel Pacheco. I'm your host with the 5 Talents podcast. If you've heard something you like today and it really got some value, which I know you did, if you didn't, rewind it, take some notes. There was some good nuggets in here. Leave us a review. Provide a 5-star rating, leave a note for Sandhya. We'd love a written review. And if you didn't enjoy the show, leave us some feedback. Tell us what we can improve on. We'd love to hear it. And if not, we appreciate your time. Hopefully we see you at our next show, our next episode. Thank you very much for your time. And Sandhya, thank you very much.
Thank you.
All right, bye-bye. Thank you for listening to this episode of the 5 Talents podcast with your host, myself, Abel Pacheco. Each week, we're going to bring you interviews from industry experts and commercial real estate investors who follow their dreams and achieve massive success. Before you leave, let me ask you a few questions. Did you enjoy this episode? Did you learn something valuable? Was your mind stretched to what's possible and what you can achieve? Do you want other experts just like the one you heard today? If you answered yes to any or all of those questions, then please take a moment to subscribe to the 5 Talents podcast, give us a 5-star rating, and most importantly, leave us a written review. Tell us what you liked. Tell us your favorite guest. Give us any feedback. I'm excited to learn and improve so you can get a more valuable show. So thank you again for subscribing to the 5 Talents Podcast.